Is my screen visible? Yes.
Yes, it is.
Okay. But before we start with the class, I would want to know how the class has been so far. If you have anything you'd want to share, your experience, what you think we can work on in the next session and all. I would want to know your comments on this. Anybody? And if you have any question at all too, you can ask and then we address that too. If you have any comment, anything at all, you can just share it. This is the last class and we'd want to get your feedback as possible so that we can work on it in the next session. So if you have anything at all you would want to share, you can just let me know. Hello. Abiodun, do you have anything you would want to share with us? Any question, anything at all?
Not really. Not at okay. Maybe what I actually would ask is maybe I'm going to ask a question that after today's class, are we still going to have opportunity to the classroom to still go over the studies?
Yes, yes. The classroom will be available to you anytime you want to go inside. You can just
Oh,
go inside after the class or anytime.
all right. All right. Thank you. Because I still have some things to perfect from the last class we had. Yeah. So that's what I would
Okay,
like to ask.
okay. It will be available to you. Yeah.
Yeah, so far the training has actually been very explainable, and yeah, I'm so grateful for the opportunity. And the teachers are very like they are very calm to explain to. So I'm not sure there's anything I would maybe want to maybe like what you should add to the maybe incoming cohorts. For me, it
Okay,
was fine. It was okay. Yeah.
okay, sure. Thank
Thank
you
you.
very much. Okay. Anybody else? Sandra Quarantine. Oh, Winifred, you were about talking.
Yeah, hello, good
Good
morning.
morning.
Um, I wanted to say, oh, so far the class has been good, but what I would like to say is that sometimes the non-accounting students like me, we get lost with some terms and those things. So maybe if the class is mostly supposed to be about financial modeling, then maybe they should limit the accounting terms and going deep into the accounting. But the teachers have been trying though, if the accounting questions come more, they try to stop them. But sometimes, you can't help it. You get lost. That's but I'm grateful for the opportunity anyway. It was very interesting. They are very calm to teach and everything.
Awesome. Okay, sure. We take your comment into consideration. Thank you very much too. Okay.
Yeah, thank you as well.
Any other person, one last person before we start today's class? Okay. So Jonathan has something to say. He will just address it and then we go into the class.
Hello, everyone. Good morning. Hello.
Hello, good morning.
Yeah, I hope we are all
Good
doing well.
morning.
Morning. We are. And
All
you?
right, sure. So, uh, I was thinking you asked about the certification, but uh, no one is asking about that. So let me clarify that. So certification will based on the attendance and then also the assignments or the assessment that we've been having over the weeks. And then we are going to have our final project. Okay, so there will be a project coming this week, and that is going to take 60% of the whole mark. And then also the assessment. So the other class, we had a discussion with them concerning the attendance of classes, but because some people, most of the students watch it from the Google Classroom, they use their link in the Google Classroom, which is the YouTube. And so they said we should make the assessment 40 rather, instead of considering the attendance. So I want to find out from you, should we consider the attendance or it should be 40/60? Because the initial plan was to have the attendance, that's the joining the live session, that is 10%, the assignment 30, and then the project to be 60. But we have decided in the other class that it should be 40/60 rather, so that the assessment will be 40%. So I want to find out from you, what is your opinion as in with regards to the certification? Anyone can talk.
So I would like to ask that, do you mean that the asset, like the classroom, the live video you join, the assignments, both of them will be 40, or just the assessment to be 40%, and then our project to be 60%? Can you hear me?
I'm not sure
Hello?
I heard you properly. If you can come again. The
Okay,
connection keeps on breaking.
okay. So my question is that the assessments, is it going to be coupled with the live classes you joined? For instance, maybe out of the 4 classes, you joined 2 or 3. So what would be the barest minimum for you to get your full mark? Because it's possible that you mix maybe 1 or 2 classes, but at least you joined 2, 3 out of the 5 or 6 classes that we had. So was that going to be a criteria for you getting the O40, or is going to be coupled with the assessment and the live classes you joined? So I would like to confirm that before making my contribution.
Okay, so the 10% is the attendance, okay, of the live session. So if you are able to attend all the 6 meetings, that is going to give you 10% of the marks. Okay, and the assignments is 30. So the assignment and then the live session is going to give you 40%. And then the project, which is the main that's what is going to give you the major point is the project. Okay, so that is 60%. And so let's say someone attends 3 sessions, that is like 40%, 50% of the 10%. And so the attendance is actually not giving you much points. It is the project and then also the assessment. Just that since you make time to join the live session, at least you get some points over there. But then we have received a number of emails from students who are actually participating through the YouTube videos. Okay. If you look at the YouTube videos, you realize that a number of people are watching, but they are not able to join the live session and they do the assignments. Okay. So if the grading of the live session, then that would be 10%. But if not, we are going to have only the assignment to be 40%. I hope you get.
Yes, I do. Yeah, I think for me it's okay since the project takes more
Adimola.
of the mark. Yes, can you hear me? Hello.
All right. So, is there any concern, any issue that you need to clarify?
No, I think I'm fine with the way it has been like allotted. It's okay. For me, it's okay.
Okay. So, Tina,
Yes. Okay. So today we are going to talk about financial
are you saying
ratios.
something, Adimola?
No, I'm not.
Okay, sure. So, the project is going to. Mhm. Okay. All right. Sure. So, the project will consider all that we've been doing from the beginning of this course. If there is something that you think you do not understand in the project, make sure you go back to the videos and then you watch them, and I believe you get some understanding from there to carry on the project. So thank you very much for your time. Ernestina will continue what we have today. All right.
Okay. So I'm sure you have this Excel workbook. That was what your tutor shared with you. It's called the BGS FMA Week 2 class content. So if you could open it with me, then because we are going to use the financial statement here to do the ratios. So if you have it with you, you could open it so that we can kickstart.
Please, I have a question to ask.
Okay, sure. Please go ahead.
Please, how long would it take us for us to complete the project? Is it a week or more than or less than?
Um, I think Mark Mills would have to answer that. Jonathan.
Okay, so the project will last for more than a week. Okay, so about 2 weeks, you should be done with the project.
Okay, thank you.
Okay.
Okay. Any other question about the project or the certification? Okay. So let's just continue. So I'd want you to open the Excel workbook with me because we are going to use the financial statements in the workbook to do the practice. Okay, so what's our financial ratios? Um, so their financial ratios are mathematical like comparisons that's are used to like assess a company's like performance and then the liquidity, solvency. I'm going to explain what liquidity is, what solvency is, and others. So is financial ratios are basically used to measure the efficiency of a company. So there are like types of financial ratios. We have the liquidity ratio, we have the solvency ratio, we have the profitability ratio. Okay, so I think I repeated solvency ratio twice, so I'm just going to delete this and then bring efficiency ratio. Okay, so when I get to efficiency ratio, I'll put the ratios under it. So it is very important to like do like ratios when you're trying to look for the efficiency of a company. So let's just say a company has come to you and the company wants to borrow money from you. So um as a person who want to lend money to the company, it is very necessary to sort of do financial ratios based on their financial statements to be able to access whether yes the company will be able to pay your loan in the duration that they've given you, or if you would want to sort of buy, let's say, MTN shares, if you want to buy any equity or any shares in any company, it is necessary to also do like your ratios so that you'll be able to know if the company is indeed worth investing in. So basically, that is what financial ratios do. It is used to assess the company's performance and the efficiency and whether the company will be able to pay off your loan, or whether the company will be able to give you a return on your investment if you would want to invest in that company. So I hope you've opened your workbook because we are going to use it to do the ratios. Hello, am I audible?
Yes,
Yes,
please,
please
you are.
Yes, you
open it.
are.
Okay, sure. So we are going to start with liquidity ratio. What's are liquidity ratios, and then how to calculate current ratio, cash ratio, and quick ratio. So liquidity ratio comprises of current ratio, the cash ratio, and the quick ratio. So what are liquidity ratios? Liquidity ratios basically are used to measure a company's ability to meet its short-term obligations as they come. So when I say short-term obligations like cash, if you have inventory, all those things are short-term. So when you see liquidity ratio, you're basically knowing whether the company will be able to settle its short-term obligations when they come. So let's go to the financial statements and calculate the liquidity ratios. So we are going to calculate the current ratio, we are going to calculate the cash ratio, and we are going to calculate the quick ratio. So what is cash ratio? Cash ratio basically measures the company's ability to pay its short-term debts. So short-term debt by like comparing the current assets. So when you come to your financial statement, the balance sheet side, please, if I'm going fast, you can just tell me that I'm going fast so that I reduce my pace. So the balance sheet side, cash ratio is going to measure the ability to pay ability to pay the short-term debt. So by comparing the current assets to the current liability. So this is the current asset and this is the current liability. So now let's do the current ratio. So I want you to open an Excel, another sheet with me, and then we do ratio calculation. So we are going to take this 15 Jan 15. So we are going to use it. So ratios are usually calculated within a period. So when you're taking when you're assessing a company's financial performance, you want to sort of look at maybe within a 5-year period, within maybe every month. Well, it's ideal to use year on year, but because the data we have here is just in months, we are going to use it. But then ideally, it's advisable to use like the annual performance or the annual statement of a company. So we are going to take the period, so the period and then the currency. So Control C, and then we do Control Alt V, and then we paste in values. So we realize that it's coming as values. So you go to home, and then you change it to short dates. Okay. Okay. So now let's start with liquidity ratios. So I did Control B to bolden it, Control U to underline it, and then Control I to italize it. So under liquidity ratio, we are going to calculate the cash ratio. And then I said that the cash ratio is equal to, so let me take this off, and then so the cash ratio is your current assets over current liabilities. So the cash ratio is basically looking at using just your cash and your cash equivalents to pay off your liabilities. So current assets into brackets, cash or cash and cash equivalent. That is a cash ratio. So we are going to head straight into it. So I think I remember your tutor teaching you cell referencing, and we are going to use it a lot here. So cash ratio is equal to, so we are looking at cash. It's just the cash over the current liabilities. So what is your cash in your financial statement? So we are going to do cell referencing. So you start with equal to, then you go and then you look for your cash. So the cash can be found in the balance sheet under current assets. So cash, you select it over your current liabilities. So current liabilities, so you take the total liabilities and then you hit enter. So it's going to calculate it for you. So this means that usually when you're doing liquidity ratios and the ratio or the answer is more than one, it means that the company will be able to settle its short-term obligations. But then if it's less than one, it means that you would probably have to search like for other ratios to be able to back it up, because it's highly probable that the company will not be able to settle its debt if the ratio is less than one. Because if, okay, so I think, so to get
Hello.
the other, yeah, hi.
Please, can you come again with the current cash ratio you just did?
Okay, sure. So I said that the cash ratio, it measures the ability of a company to pay off its short-term debt. So whatever, like if the company is owing another person, you the company would, like, you would want to use the cash ratio to check if really the company will be able to settle the debt that it's owing. So cash ratio takes into consideration just the cash component, just the cash component of the current asset over the current liabilities. So to get the cash ratio, I said that you are going to do cell referencing, and then you are going to look for your cash component in the balance sheet and then the current liabilities. So the current liabilities is the total current liabilities. So we are going to use cell referencing to get it. So equal to, you start with equal to, then you go into your financial statement and then you pick the cash figure. So cash over your total liabilities is this. You select it and then you hit enter. So I said this means that the company it will be able to settle its short-term debt because it is more than one. So if the answer was less than one, it probably means that you would probably have to look further, or you have to look into the company and see if it will be able to settle the short-term debt. So to get the ratio, or to get the answer for the other period, what you would have to do is just take the small box and then you drag to your right, and then it will be able to pick for you. Okay, so any questions so far? Any questions so far? Okay, so we are done with cash ratio. We are going to move to the current ratio. So current ratio. So the current ratio is almost the same as the cash ratio, just that the cash ratio is just cash, but current ratio is basically the current assets. So basically, a company, like, current ratio is used to measure like how the company will be able to settle its short-term debt using the current assets over the current liabilities. So we are using current because current assets are the assets that are within 1 year. Current liabilities are the liabilities that are within 1 year. So those ones are easily convertible to cash. So that is why it's under liquidity. So when you hear liquidity, you should always have in mind that liquidity is basically converting assets to cash. So liquidity ratios convert how easily you can convert your assets into cash. That is liquidity. So current ratio is your current assets. So let's just repeat this, but then we are going to take the into brackets cash out. So you hit enter to pick it, and then you go into the cell, and then we take the cash. So let's calculate the current ratio. So the formula says current assets over current liabilities. So we are going into our financial statement. We are going to pick our total current assets. So our total current assets is this over current liabilities. So the total liabilities. Then you hit enter. So this is also more than one. So it basically means that the company is highly liquid, meaning that it can easily convert the current assets to cash to meet its short-term debt or obligations. So to get the other periods, we are just going to drag to the right to get the other period. So the next is quick ratio. Any question on current ratio? Okay, so quick ratio. So what is quick ratio? So all the ratios basically are to convert assets, how easily you can convert assets to cash. But then for each of the ratio, the components differ. So for quick ratio, it's basically the same, but then we are not going to add inventory because inventory sometimes is very difficult to convert to cash within the space of 1 year. So quick ratio is also the current assets minus your inventory, because sometimes it's difficult to convert your inventory to cash. That's where we are taking the inventory out. So we are also using this to check if really without the inventory, the company will be able to settle its short-term debt. So over current liabilities. So now let's calculate the quick ratio. So equal to, so current assets minus your inventory. So you pick the inventory over your current liability, so the total liabilities, then you hit enter. Okay, so why are we getting this figure? It's because we didn't put the current assets and then the minus inventory in bracket. So the over, the one dividing it is picking just the number after the negative. So it's advisable to always put your formula or the one as the on top in bracket. So yeah. So we are going to take this and then we put it in brackets. Okay. So that is a quick ratio. Then we just drag. So for this, we can say that the company is highly liquid because even without the inventory, it's able to like meet its short-term debt, because after we computed for it, it's even more than one, and it's even like more than 10. So it's highly liquid. So if say you want to invest in this company for a short-term period and then you are using the liquidity ratio to check, you can conclude that the company is highly liquid and you would want to invest or you would want to give your money to that company. That's if if you would want your money back or if you would want your return within the space of a year. Okay, so we are done with liquidity ratio. Any question on liquidity ratio? Any question on liquidity ratio? No question? Okay. So let's move to the next type of ratio, solvency ratio. So solvency ratio. So liquidity ratio is used to meet short-term obligations. Solvency ratio is used to meet long-term obligations. So if you are investing in a company for a long term, if you are loaning money to a company to get your money back in the long term, you could use the solvency ratio. So sometimes what the company is about or what the company wants to do is what ratio that it like is what will determine the type of ratio that you should take into consideration. So solvency ratio basically is the ability, it's basically used to measure like the company's ability to meet its short-term obligations. Okay, so let's move to the debt ratio. So debt ratio. So this company, I said solvency ratio is for long-term obligations, but here we are seeing that we don't have we don't have long-term liabilities. So just for the sake of the ratios that we are computing, let's just add long-term liabilities. So this is total current liabilities. So we have the so let's do long-term liability. So let's just put something like again, this is not realistic. Like the figures I'm putting there are not realistic. So let's just put like long-term liability. So we have a long-term loan. Long-term loan. So we are putting something like 100,000. 110, 110,000, 11500, 115,000. So since it's just one, we are just going to take this. So now let's go and then calculate our solvency ratio. So Control B U I. Okay. So we have the debt ratio, which is basically measuring your total liabilities over.
Hey, the guy is here, so good.
Is please anybody asking a
Yes,
question?
yeah.
Yeah, hi. Anybody asking a question?
Yes, I mean he's facing you. That you
Sorry, please, I didn't get that. Okay, so let me move on. Okay, so that ratio is basically your total liabilities over your total assets. So let's just compute for your total liabilities. Control plus. So total liabilities. So anybody to help me with the computation for the total liabilities. How do I get my total liabilities? Anybody? How do I get my total liabilities? How do I get my total liabilities? Godwin, can you help me? Okay, Isabella, please go ahead.
please, I didn't raise my hand though.
Oh, okay. But you can.
But
Yeah,
the total liabilities, do you mean both short and long term liabilities?
exactly. So,
Okay, so it's equal to B47
mhm,
plus B15.
awesome. Okay, that's right. Thank you very much.
Yeah,
So
welcome.
that is the total liabilities, and then to get the other period, I said that you just drag to the right to get the other period. So you can see that it's picking C47 plus C50. It's picking it. So let's calculate the debt ratio. So debt ratio debt ratio is your total liabilities over your total assets. So let's compute the debt ratio equal to total liabilities, this over your total assets. So this is your total assets. So this is what you are getting for the total for the debt ratio. It means that the company will be able to use the total assets to settle the total liabilities, because we are seeing that the total assets is higher than the total liabilities. So a ratio of less than 1 for debt ratio, it shows that the company will be able to meet its long-term obligations. So whilst the liquidity ratio with this is supposed to be more than 1 to show that it's meeting its short-term obligations, solvency ratio is supposed to be less than 1 to show that it's really meeting the long-term obligations. So let's just drag this to the right to get the other periods. Yeah. So that is for debt ratio. Now let's move to debt to equity ratio. So debt to equity, debt to equity ratio. So debt to equity ratio is also measuring the proportion of a company's debt to its equity. So a higher ratio will basically suggest that the company is highly leveraged. So like is at if the ratio is higher than 1, it means that the company is at a higher risk of default. So it means that the company might not be able to settle its long-term obligation if it's more than 1, or if the ratio is higher. So debt to equity ratio is basically calculated as total debt. So the total debt, we are looking at the long-term liabilities. So we are taking out the current liabilities. So debt to equity is the long-term liability. Long-term liabilities.
And please, can you come again with the explanation of debt to equity ratio?
Okay. So I said that the debt to equity ratio, it measures it's basically the debt, it measures the long-term debt of a company to the equity of a company. So I said that if the ratio is higher than 1, it means that the company is at a higher risk of default, meaning that it will not be able to settle its long-term debt. So when you're looking at debt to equity ratio or any solvency ratio, you should just make sure that if you want to sort of give a loan to the company, you would have to ensure that maybe the ratio is less than 1. So debt to equity ratio is total debt, but then it takes into consideration just the long-term debt. So it doesn't add the short-term debt or the current liabilities. So the total debt over your equities. So you're not using assets here, we are using equity, because when you loan or when you give money to the company, automatically you have an equity or you have a share in the company. So let's check the financial statement to see if there's equity. Okay, there's equity. So now let's calculate. So debt to equity ratio is your long-term debt over equity. So that's equity control C, then control V. So equal to long-term debt. Long-term debt is 100. So the first one is 100,000 over your long-term equity. So the total equity is this. So with this, we are seeing that the the ratio is less than 1. It means that the company can be able to settle its long-term debt because it is less than 1. I mean, if it was more than 1, it means it will be at a risk of default. And when you are trying to, if it's more than 1 n, like if you want to loan money to a company and then you realize that it's more than 1, then you should actually think twice about loaning money to the company, because you should know that it's highly probable that they are not going to settle, they're not going to be able to pay your money to you when the time is due. Okay, so we move to the next ratio. So the next ratio is the debt to capital ratio. So let me see if I added it here. Okay, so we have the equity ratio. So we do the equity ratio. So basically looking at the total equity over the total assets. So the equity ratio, total equity over total assets. Now let's compute for two. So your total equity is this over total assets. So total assets is this. You are getting this. So it means that the company can be able to use the total assets to settle the equities, or to settle all the money that's like all the money that people have been able to invest into the company. So in any case where the company would want to settle the debt, it can be able to use the total assets to settle the debt. Right. Okay. So we move to the next ratio. But before that, let me see if, yes. So the last one is the interest coverage ratio. So interest coverage ratio is like, it actually measures the company's like ability to meet its interest payments on its debt. So if you're loaning money to a company, ideally you would want an interest on the loan that you are giving to the company. And this is what interest coverage ratio does. It actually checks to see if really the company will be able to pay your interest on the loan that you gave to them. So if for this particular one, you should know that if the interest coverage ratio is less than 1, it means that the company is not generating enough income to pay like, or to cover the interest payment. So all the solvency ratios are supposed to be like less than 1 before it makes sense. But then for the interest coverage ratio, it has to be more than 1 to show that really the company will be able to settle the interest payments. So interest coverage ratio. So we have, so interest coverage ratio, it uses the earnings before interest and taxes. So earnings before interest and taxes. So it's basically the income that you are getting before interest and taxes are subtracted from it. So because we are calculating interest coverage, we wouldn't want to add the interest and the taxes that is being paid. So interest coverage ratio is earnings before interest and taxes over your interest payments. So over your interest payments. So over here, we don't have the earnings before interest and tax, but then, and then also we don't have the interest payments. So ideally, the earnings before interest and tax would have been here, and then the interest payment would have been part of the expenses. So you pick the interest payment from the expense side, and then the earnings before interest and tax would have been here, like maybe here, then tax will come, then interest will come before earnings after tax. But we don't have it. So we are just going to explain that, but we are not going to compute for it. So we are done with solvency. Any question before I move to the next ratio? Any question? Any question before I move to the next ratio? Please, I want you to ask me questions. So I want to make sure that you understand this particular aspect, because this is the last class we are going to be having. Any question? No question? No question. Okay. So then I'm guessing that you understand what I'm teaching. Okay. So let's move to profitability ratios. So profitability ratio, it measures a company's ability to like generate profit from its operations. So profitability ratio is used to measure, or is used to check whether the company is able to make profits from its operations. So let's move to profitability. So control C. I want to copy the format. Control V, then profitability. So with that, the we have net profit margin, we have gross profit margin, we have operating profit margin, we have return on assets and return on equity. So we are going to take the first one, net profit margin. So what is net profit margin? It measures, like, the net profit margin measures the percentage of revenue. So with profitability ratios, we are looking at percentages. So it measures the percentage of revenue that remains, like, after all the expenses have been deducted, including the tax and interest, all of them have been deducted or subtracted. So if the net profit margin is high, it means that the company is generating profit and is able to, like, is generating profit and is also efficient in its operations. So let's compute net profit margin. So let me copy this and then paste it here to type the formula. So it's the net profit over the sales, or the sales is also the revenue. So let me just put the revenue. So equal to net profit. So this is our net profit. and we are realizing that, okay, well, let's finish. Net profit over the sales. So this is your sales. So with this, I said is for profitability ratios is usually in percentages. So this shows that the company is not efficient at all because first it made loss. It didn't even make a profit. So it made losses of this and then made a profit of this. So it means the company cannot even make profits from its operations after taxes have been deducted, after all expenses have been taken from it. So this one means it can't make profits from it. So let's move on to the next one, gross profit margin. So if net profit margin is the net profit over sales and revenue, can somebody tell me what gross profit margin would be? What would be the formula for gross profit margin? Anybody to help me?
Gross profits over revenue
Awesome.
times
That's right.
100.
That's okay. Well, yes, that's right. So she brought times 100 because when you try and do this, without the times 100, it's going to give you in numbers before you would have to use a percentage to convert it to percentage. So if you don't want to if you want to bring the 100, or if you don't want to convert it after it has calculated for you, you can add the times 100. So gross profit over revenue or sales in times 100. So let me just bring the times 100. But you have to know that if you are adding the times 100, then you have to put the formula in brackets. You have to put the numerator in brackets, else, sorry, you have to put the first one in bracket, else it's going to pick only the revenue and not the gross profit. So now let's go. So equal to gross profit. So this is our gross profit over revenue times 100. So this is it. So we have 25. But I'm realizing that it's not bringing the percentage. So it is ideal to use this without the times 100, or let's try times 100% and see if the percentage will come. So you're seeing that even if you use a percent, it's not going to work. So you just use this and then you add your percent, you just convert it to percentage and then you go. So the gross profit is 25%. So the highest we want is 100%, and 25% is far, like, is not even close to 100%. It means that the company is also not really efficient because it can't like make enough gross profit, or it can't make enough profit. Yeah. So this also shows that it's not efficient. I mean, with this same company, we are getting a net profit of this. So what shows that the gross profit is even going to be efficient for you to even assess that it's going to, like, it's profitable. Yeah. So let's move to the next. Operating profit margin. So operating profit margin too. There's a hand up, please. The person, sorry, because I'm sharing my screen, I can't really see. So please ask your question.
Auntie, please, I can't.
find a document to use for the work.
Wow. How long has your hand been up?
For a while now, but then you've not seen it, so
Oh, you should have just spoken. You should have just spoken because right now we are
oh, I'm
almost.
I'm following though, but then I don't have the document to use to practice. But not having it won't really affect it since I'm still following.
Okay, then it's not a problem.
Okay.
Okay.
But please, how can I get it?
So we'll just I think it's already like in the Google Classroom because I think your tutor Anthony had already shared it with you, and that's what people were using for some time now before we went for the break. So you just go into the classroom and then you search for this. But
Okay.
I'll drop this also into the classroom for you.
Okay. Thank you.
You're welcome. Okay. So the next is operating profit margin. So with this, oh, so here we don't have our operating profit. Operating profit is actually almost the same as the net profit. You see, so you can, well, people interchangeably use operating profit with net profit. So we wouldn't really want to go into it that much. So operating profit basically is like after your, it's before tax and interest has been sorry, before tax and then your interest has been deducted. That is operating profit. That is what is usually called the EBITDA. So here, let me see. Yes, so here there's no operating profit. So we can use net profit as the operating profit because we don't have tax, we don't have interest. So if there was tax and then interest here, this would have been operating profits. Operating profit before the tax and the interest would have been deducted to get your net profit. So here we don't have operating profit. So let me just send it back to how it was. So we are going to skip this and then move to return on assets. So return on assets basically it measures the return on the assets of the company. So let's calculate the return on assets. So if the return on assets is high, it basically means that like the company is generating a lot of profits from its operations whilst it's keeping the assets low. So return on assets is basically not using a lot of assets to generate profit. So like you're generating profit, but then you're not using a lot of assets to generate your profit, but then you're generating your profit. So let's do return on assets. So the formula for return on assets is the net profit, net profit, net profit over your total assets, over your total assets. So we are going to see if the company made a lot of profits while using the least assets that they have. So net profit, sorry, return on assets, return on assets. So equal to net profits over total assets. So this is your total asset. percentage. So this shows that the company doesn't make profit at all when it's using the assets. It means that it's even in a negative, meaning that the company uses a lot of assets to make profit and even still it's not making profit, meaning the asset is not even enough for the company to make profit. So let's move to the next one, which is return on equity. So return on equity, return on equity. So what is return on equity? Return on equity is basically used to measure the company's like return on the shareholders' investment in the company. So return on equity is the net profits Please give me a minute. Okay, so the net profit over your return, sorry, over your total equities. Net profit over total equities. So
And
return.
please, what do you say the return on equities is to measure?
So the return on equity is used to measure the return on your on the return on the shareholders investment, so in the company.
Yeah, hello guys. I think Tina's network is messing up right now. Let's hold on for some few minutes. Okay, I'm coming. Yeah, hello everyone. Please, can you hear me?
Yeah, we can hear you.
Okay, so I'm trying to reach Ernestina and I'm not able to do that. So what we are going to do is to that she's almost done with today's session. We have about 10 minutes to end the class, but then unfortunately we've lost her on the call. So she will record if there is any point to make into what she has already done. She's going to record that and then I will share that with you. So for now, I want us to end today's session. That's quite unfortunate, but then whatever she have for us, I will make sure it gets to you. And so all other information will be communicated to you through your emails and then the WhatsApp platform. So uh, thank you very much for your time. If there is something that you think you have for us, I'll be listening. Okay, so I don't know if someone have a comment or a suggestion or a question. I think we can do that now and then end the session today. Okay, so if there is nothing like that, I think we will end it here and continue our interaction on the WhatsApp platform. Thank you very much. Bye.
Bye. Thanks, me too.
Welcome.